Hi everyone, and welcome to today's CMC Markets presentation, 5 minutes a day trading. However, before we look at this trading strategy, there's some important information to consider. First of all, the information in this presentation is introductory and presents a high-level overview. Whether or not the trading strategy presented in this video is of use to you is entirely your decision. And if you have any concerns or doubts around that, please seek independent advice. Secondly, we're talking about trading using CFDs. CFDs involve leverage and they obey the economic law. That leverage has the potential to magnify potential rewards, but can also magnify potential losses, potential risks. And anybody trading CFDs should be aware of those risks. And once again, if there's further information available in our product disclosure statement on our website or by calling the 1300 number on the screen in front of you. But if you're unsure of any of those risks, please once again seek independent advice. Now, trading in markets can be all-consuming. They'll take as much time as an individual is willing to give. And one of the challenges for many experienced traders is reducing the amount of time spent in front of a screen. Now, very few are able to reduce that time spent on trading to just 5 minutes a day, but it is possible. One of the lessons I learnt as a young market maker on the ASX options trading floor is to remain open to all sorts of information. And in a conversation with one of the department heads here at CMC, he pointed out that when he was trading the CMC tracker platform, trialling it as part of the testing phase, he noticed that he thought the European traders got the euro-US dollar wrong on the opening more often than they got it right. That is, the first moves after the European opening were in the wrong direction compared to the overall thrust of trading for that day. Now, taking that idea and some trading knowledge, I worked with one of the quants here to come up with a trading strategy that would take advantage of that quirk in the euro-US dollar market. And I relied on two of the key measures for trading success in coming up with this strategy. That is the percentage of successful trades combined with a profit to loss ratio, the reward to risk ratio. Now, many new traders are surprised to hear that a trader can be profitable with less than 50% of successful trades. And the way that can be done is to employ that signal selection method that results in less than 50% successful trades with a stronger profit to loss ratio. And so that's what I was looking for in analysing the data of the euro-US dollar after the European opening. A good signal that could be combined with a profit to loss ratio that would deliver overall profitability. And this is what the results of the analysis showed. If we observe the euro-US dollar at 3 o'clock Sydney time at the moment, that would be 5 p.m. in summer to adjust for daylight saving, a strategy that involves buying at 17 pips under that opening price and at the same time placing an order to sell at 28 pips over the price, combined with a profit to loss ratio of 3-to-1, that is a stop loss order at 15 pips and a take profit order at 45 pips, resulted in a profitable strategy over the 8 months of my study. Now, just to repeat, that's about placing two orders, one to buy at 17 under, one to sell at 28 over. Once one of those orders is triggered, the other is cancelled straight away, and we allow the stop loss orders and take profit orders to do their work. And here are the results of employing that strategy over the 8 months from November last year to June this year. Each of the months is broken down into the number of trade days, whether or not that resulted in a buy or sell entry, and then whether or not it hit the price target or the stop loss order first. And down the bottom here is a summary for each month. Now you can see there's 21 to 23 trading days in most months, and the number of successful trades is the main driver of profitability. In the worst month, there were only 4 successful trades, and that resulted in an overall loss of 90 pips. In the best month, there was 11 successful trades, and that resulted in an overall gain of 345 pips. What's interesting about this table is to note that although there's an equal number of winning and losing months, the losses at minus 90, minus 15, minus 30 and minus 15 are far outweighed by the profits of between plus 75 and plus 345. And in fact, over the course of this study, this strategy delivered a profit of 570 pips. Now, some care should be taken in looking at this table. Past performance is not a guide to future returns, and so this may not be a conclusive study, but it's enough for me to think about this as a trading strategy. And here's an example from the 26th of July of how the trade would work. The green arrow is at 3 o'clock, and that represents our reference price on the euro US dollar. At that time, it was at 121.38. A trader using this strategy would then place their two orders, one to buy at 17 under, one to sell at 28 over. And in this case, it was the buy at 17 under that was activated. The sell order is then immediately cancelled, and the buy order has attached stop loss at minus 15 and take profit at plus 45. The stop wasn't triggered in this example, and then the rise that we saw before 9 o'clock Sydney time meant that a profit of 45 pips was taken on this trade. Now, as you saw from the table before, on the majority of days, with one exception, this trade will hit its stop loss before the take profit. But that higher value in the take profit meant that the strategy was profitable overall. There are some risks in this trade, and it's important to know what they are. And the first one is one we've discussed already, that there's not enough successful days in the month. In a 22-day trading month, we need 6 days to be successful in order to turn a profit. And any increase over that number of 6 represents increased profit. There are other risks, however. One of them is slippage. But as in this case, we're looking at the largest single market in the world, the euro US dollar. It's not only the most liquid, but generally has the tightest spreads. So slippage should not be a major concern in this trading strategy. It can still occur, but it shouldn't have a material impact on trading profitability. A bigger risk is a failure to place a trade. With this strategy relying on only 6 trading days a month to be profitable, missing just one of those days could make a material difference to the result. And traders looking to utilise a strategy like this would have to make every effort to trade every day of the month. The study also assumed that all of the trade sizes were equal. That is, the trade placed each day was at the same size. Varying the trade size could also have a material impact on the results of the study. Now, for more information about the 5 minutes a day trading strategy and an example trade, you can go to our blog. And the address is on the screen in front of you, blog.cmcmarkets.com.au.